We would all like to be millionaires. Well, except for the elite bunch of us who happen to be billionaires. It's easy to think of it as an impossible goal, but it really isn't for most of us. In fact, it's probably easier than you'd think. You might achieve the goal through a large inheritance, or by beating the odds of tens of millions to one and winning a lottery jackpot. Don't count on either of those. Instead, put a Roth IRA to work for you and enjoy the eighth wonder of the world in the way most wealthy people earn their millions, through compound interest. There are two main kinds of IRAs, the traditional and the Roth. With a traditional IRA, you contribute money on a pre-tax basis. The value of your contributions is subtracted from your taxable income, so it reduces the tax that you pay for the year that you contribute. For example, if your taxable income is $60,000 and you contribute $5,000, your taxable income falls to $55,000, shielding $5,000 from tax in your contribution year. The money grows tax-deferred until you withdraw it in retirement, when it's taxed as ordinary income. Additionally, you must begin withdrawing at age 70 and a half. The Roth IRA is different in a few respects. It accepts only post-tax contributions, so you get no tax break up front for the year that you contribute. If you have a taxable income of $60,000 and a contribution of $5,000, your taxable income is still $60,000. But if you follow the rules, you can withdraw the money in retirement completely tax-free. It also imposes no required minimum distributions starting at age 70 and a half. The IRA contribution limit for both Roth IRA and traditional IRAs are the same for 2019, $6,000 plus an extra $1,000 catch-up contribution for those age 50 or older. Also, if you're married, you may contribute double these amounts. The miracle of compounding is what can make money grow more and more briskly over time. Imagine a sum, say $10,000, growing by 10% annually, for example. In the first year, it's 10% bigger, increasing by $1,000 to $11,000. In the second year, that $11,000 grows by 10%, which is now $1,100, and you end up with $12,100. The year after, that result grows by 10%, $1,210, then becoming $13,310. The point here is not only to see how, in just a few years, your initial $10,000 is growing, but that the amount by which it's growing is growing too. First $1,000, then $1,100, then $1,210, and $1,331. The Roth IRA can make the compounding effect even stronger for you because it takes taxes out of the equation. The money you contribute is post-tax money, but it grows and gets withdrawn tax-free. Let's see how the growth happens in just a few scenarios. The table shows you how much you can accumulate if you contribute $6,000 per year for 10, 20, 30, and 40 years. It also shows the difference that the average annual growth rate can make. The U.S. stock market has averaged about 10% annual returns over many decades. These numbers show what you can achieve with a below-average, average, and above-average rates of return because you can't know what your particular time period will deliver. Including bonds in your mix will likely lower your average return too. Still, it's clear that you can accumulate $1 million if you have a few decades in front of you. If you don't have a few decades in front of you, or are just impatient, remember that the contribution limits for IRAs increase over time and are adjusted for inflation. So, you'll be able to contribute more than $6,000 per year for most of these years. Also, when you turn 50 years old, you're allowed the additional $1,000 catch-up contribution. You can also invest additional sums in other accounts. Moreover, if you already have $50,000 or $100,000 or $250,000 in accumulated wealth, getting to $1 million will be even easier and faster as you'll have compounded returns, putting money in your pocket. The Roth IRA maximum contribution is reasonably achievable at $6,000 per year or $500 per month, which is less than 15% of the average salary in the United States. It also happens to be less than the average new car payment. If you don't feel that you can make the maximum contribution, consider starting a side hustle, getting a part-time job, or working online in your spare time to ensure that you make those contributions that will reward you in years to come. Remember also that in order to achieve the market's average return, you'll probably want to invest in a low-cost, broad market index fund, such as the SPDR S&P 500 ETF, Vanguard Total Stock Market ETF, and Vanguard Total World Stock ETF. Respectively, they distribute your assets across 80% of the U.S. stock market, the entire U.S. market, or just about all of the world's stock market. Also, the fees on these index funds will be much lower than that of comparable mutual funds, allowing you to invest practically for free. You could aim to beat the market by carefully selecting individual stocks, but that will take time and skill. If you're interested in that, perhaps divide your investments between index funds and individual stocks to minimize the risk. Just remember that without vast sums of money, it takes perseverance and dedication to become a millionaire. A Roth IRA is one way to help you get there, building you a comfortable and enjoyable retirement.